Jonathan Nichols joins me here today, and you can find what his team is up to by heading over to apogeemfc.com. I'm going to have that as a clickable link in the show notes, but really appreciate your time, Jonathan. You got kind of an interesting story, and we're going to do kind of a truncated version of how you found your way into real estate investing. So, Jonathan, let's start things off. You had mentioned you have a story associated with your domain name to begin with.
Yeah, absolutely, and appreciate you having me on the podcast, Jack. So, the Apogee name comes from my background. I worked formerly as an aerospace engineer. That was like my passion or dream growing up was to be an aerospace engineer and work on all things that fly. And so, when you're in aerospace engineering school, apogee is a very specific term that we use specifically, like when you're calculating satellite orbits. And basically, it's the furthest point on the orbit where a satellite can reach. Well, the more colloquial definition of apogee, if you look it up in the dictionary, it's basically like the pinnacle or summit of something or like reaching the summit of something. And so it's really a word that unites my past career experience as an aerospace engineer together with what I'm doing today, which is helping investors reach their financial potential, their financial peak, if you will, through real estate investing.
So, got to ask, like, you're an aerospace engineer. Why ditch that and go into real estate investing?
Yeah, so I might have to blame my wife for that. I grew up, like I said, wanting to be an aerospace engineer, and we got married about 8 years ago. Shortly after getting married, she wanted us to find a hobby together. And we decided rather than picking up a hobby that we would have to pay for, we should pick something that would pay us. And so we both became interested in real estate investing. She really encouraged me. She said, "Hey, like with your skill set as an engineer, the analytical mindset, the ability to drive projects, I think you could be really good in this industry." And ironically, she was a finance major and a management consultant. And so we teamed up together, and the rest is history from there. We did a couple years of single family investing that was successful and then transitioned over to commercial multifamily, which we've been doing now for about 4 years time. So that's the nutshell version of the story.
And what was it like to make the commitment to jump into it full time?
Yeah, for me, going full time was not as difficult as just getting started in the beginning. I think there's just kind of this, it's interesting because our first property we bought, we probably spent 30K on down payment, on renovations, on closing costs, which for real estate, that's not a lot of money to invest, honestly. But for us, it was a significant investment. And it's interesting because I think we've been kind of pre programmed in culture to think, well, if you spend 30K on a car, that's fine. You shouldn't sweat that. Or you spend 30K on a wedding, that's fine. But you're going to put it on an investment that could hopefully make you money. And suddenly there's all this fear and stigma around it. And so I think it was just kind of pushing through that initial wall of fear or uncertainty and getting through to the other side. And one being like, hey, everything's okay. But two, more importantly, hey, this actually can generate wealth. It can build wealth through investing. And so after we saw that, it was full throttle ahead. But just getting through that first bit of uncertainty was the difficult part, to be honest.
So you put a lot of credit towards your wife on getting you into this. Like, talk a little bit about that. Was she consuming books or podcasts, or what was the spark that pushed her in this direction?
Yeah. So it's probably going to sound a little bit mundane to your listeners because I'm sure they've heard it before. I'm an avid reader. And, right after we got married, I actually picked up the book Rich Dad, Poor Dad. And that's kind of what got the wheels turning in my head. I think my wife had honestly always had a little bit of an inclination towards investing in real estate. Like I said, she was a finance major. She actually helped her parents buy their house when she was like 14 or 15 years old and had a really successful purchase there, buying them a great deal. And so I think she already had an interest in it, but that's where she's like, hey, we can unite on this together. But beyond that, it was encouragement. It was saying, hey, I think that, you could do well at this. And, she encouraged us to do it together. And then eventually, I went full time, which she was a big part of. And then about a year after I went full time, she also went full time. So now we both run Apogee together as our full time jobs.
Talk a little bit about the moving from the single family homes to the multifamily. Was that another jump, or did that seem like a natural fit?
Yeah, it was. I would say the natural part or the reason we decided to switch from single family to multifamily One is just economies of scale. For those of your listeners that are familiar with both avenues, there's successful investors in single family and there's successful investors in multifamily. But if you're able and willing to do a larger real estate project, you have the potential of being able to earn more, bring more value to the market in one project. And so that was kind of the appeal of it. But I think for us specifically, we realized in single family what we were good at and what we were not good at. So, we were good at finding deals. We were good at analyzing deals. We were good at project management. We are not handy people. Like, we're not the ones that are going to be fixing things or doing a lot of that. That's not our strengths. And so I think in commercial, because you can hire, due to the scale, property managers to run the day to day, contractors to drive the renovations, it made a lot more sense to us because we can focus on things that are our strengths, which is what I mentioned, the analytical side of it, the project management side, the things that would be probably more associated with our former professions.
Sure. So the natural step then is you're getting into multifamily. Was your first multifamily purchase on your own, or did you jump into getting some investors involved?
That's a great question. Well, our first residential property, if you will, that we bought was actually a fourplex, which your listeners may know is technically a residential property, but still a residential multifamily. So we had just a little taste of it, if you will. But our first commercial project was a syndication where we pulled investors together. And you kind of asked, like, what's one of the big mindset shifts that you have to go through from single family to multifamily? And if I could only name one, I would say it's the power of partnerships. Because in the single family world, she and I did everything together. We would analyze the deal, put the deal under contract, buy the deal, put the down payment for the deal, renovate the deal, whatever it was. But really, in large scale commercial, these deals are almost always done with partnerships. So we had to go out and organically build relationships with other people who could complement our weaknesses and help us to be able to put one of these projects together and execute it successfully. So that was probably the biggest change in mindset along the way.
Well, that's not just a big mindset change. That's a completely different process. What was some of the biggest things that surprised you there?
Yeah, I think the biggest thing that surprised me is, like I said, because we were syndicating, soliciting investors. In our case, we were doing 506B. So these are friends, family, professional contacts that we had a relationship with. I thought it would be difficult to get people on board to want to invest in real estate. And at least at the time when we started, it was actually not easy, but rather simple. And I think it's because there's such a strong value proposition behind it. There's a lot of people, most people out there recognize that real estate, if done correctly, is a good investment vehicle. They may not know why, and they certainly may not know how to get in, but they at least recognize, hey, you can make money in real estate as an investment. And so when you provide them a path where they can do that without needing their own time or experience to do it, that's something that appeals to a lot of people, particularly busy professionals, which is a lot of what our network is comprised of. So biggest surprise was just how accepting people were of the idea and willing to partner with us.
So with that syndication, what was the size of the property you acquired?
Yeah, our first deal that we did, it was a 100-unit multifamily property in Oklahoma, in Tulsa area specifically. We did it with 3 other partners, so there's really 4 of us together on the active side, putting the deal together, finding the deal, doing the due diligence, putting down the risk money, and getting it to closing. We still own that property today. It's done quite well. One thing I encourage a lot of people going to the multifamily world is if you can partner with, say, 4 people together and do a 100-unit deal, it makes a lot more sense because you can afford to have full-time staff running your property, right? So maybe by myself, I could have only done a 25-unit deal at that time. But with the power, of these other partners working together with us, we were able to do 100 units. And it just lets things run a lot smoother when you have full-time staff that, their 140-hour-a-week job is running your property.
So that's the sweet spot when you can have people on site, full-time staff is 100 units, you think?
I think that's probably a general rule of thumb. The truth is it's more dependent on income than it is on unit count, right? But obviously there's a correlation between the two. So we have another property that's 75 units where we basically have full-time ownership on it, but it's an A-class property, meaning the rents are significantly higher. So it produces comparable income to this other 100-unit property, right? But just in general, 100 units is probably a good rule of thumb where things start making a lot more sense financially, having full-time staff there at the property.
What are your current plans? What are you working on right now?
Yeah. So, we started in multifamily during COVID, which was obviously a very dynamic time, continued to buy, 2021, 22. The years 22 and 23 were very difficult years to buy. With rates continuing to go up, it was difficult to find a deal where it wasn't like you're catching a falling knife, to be quite honest. We only did one syndication project in 22 and then another one in 23. But once rates stabilize, we really realize that this is a short window of opportunity in our minds to buy large commercial assets at a discount. So a lot of multifamily compared to the pricing that you would have seen late 2021 or early 22 is now 20 to 30% discounted in the markets where we look for properties at. And so we're out there trying to buy as much as we can right now. Last year in 24, we did 3 syndication projects in total, which is about 400 units, and have pretty similar goals for this year in 25. I think if you look back during the 2008 recession and real estate crash at that time, and talk to investors who went through that, their biggest regret was when things were down, they didn't jump in and try to buy more at that time. And so we're really trying to take advantage of what we see as a short window of opportunity and do as much as we can, obviously at a responsible level.
Well, with all of this then, and the volume you're talking about is pretty significant. How has the process of scaling w- been working out?
Yeah, I would say it's a little bit easier with Paula and I together, and also with the strong number of partnerships that we've built to date. I think one of the most important things is in whatever market you're in, having a strong property manager. If you have a really good property manager, that's driving the day to day, that's driving your business plan forward, it makes your job as a deal sponsor significantly easier. If you have more like a B minus or C level property manager that doesn't do as good a job, you as the sponsor have to take on the additional gaps that they leave to ensure that your business plan is executed the way that you want it to. And so, one bit of advice I would give is as you're building out your team, really focus heavily on the property manager. They can make and break your deal, and they can also make your life significantly easier or more difficult depending on their level of competency.
How do you ensure that the property manager you're leveraging, your interests stay aligned so that it is a good fit?
Yeah, so it might be a bit controversial, but I would say that the interests are almost never going to be aligned if you're using third party management. Just the nature of the two businesses and what incentivizes them versus you, very difficult for those interests to align. And so, what that means is that you, as a deal sponsor, you have to take the ball and run with when it comes to making sure that they are executing on the plan that you've paid them to. What it looks like for us is we have weekly management calls where we go through a KPI spreadsheet, key performance indicator. And we'll look at everything from occupancy to how quickly we're getting maintenance requests done, to unit turn timelines and costs, to delinquency reports, and basically all these key metrics that we want to know on a weekly basis to ensure that both the day-to-day operations and the renovations or overall business plan are being executed, per time and on budget. I think if you're looking at investing passively with someone, you want to make sure that that operator has those kinds of systems and habits in place, because that's ultimately what's going to determine if the property manager is going to do what they need to do to execute on the business plan and drive the value.
Yeah. It sounds like you're essentially working into the process, the squeaky wheel, right? You have to just stay on top of it.
That often investors will want to shadow you or, see what you're doing. And they think it's really exciting. And sometimes it is really exciting, but a lot of times it's just the mundane, right? Pulling reports, reviewing reports. Probably the most challenging part is when something goes wrong, trying to figure out what the issue is and how do we correct it. So that's a big part of what our job is, something goes wrong is coming up with a solution, yes, that's going to fix whatever the given.
So, Jonathan, I think you're just revealing the fact that this is not passive. Everybody gets into this real estate investing, and there's always going to be some level of work involved, and in your case, quite a bit of it. Talk about those people interested in investing in syndications and what some of the questions they should be asking to make sure that the syndicator knows what they're doing and that if it's a good fit for the investor.
That's an important topic. So first of all, just to reiterate what you said, the investor or sponsor on a deal, we're running a business and it's no different than any other business, whether you're open a restaurant or, retail shop, in the sense that you can delegate, you can hire people, you can hire managers, but it's never 100% passive. You have to keep your on the road, so to speak, and pay attention to what's going on as the operator. And even more so when you have investors that are trusting you with their funds in a given project. So a few things I would say, you passive investors, you actually have a big advantage now as opposed to a few years ago. So 2 or 3 years ago, because the economy, within real estate was just going up and up, mediocre sponsors or operators had good results to show for their projects in terms of full cycle deals or returns provided. And they had good results just based on how well the economy had done. And so it was very difficult when you were vetting sponsors to see if their positive results were due to them being a great operator or just, riding the tailwinds of the economy. Well, today, although there's been a lot of challenges within the investing role within real estate, one of the positives is we now have a little bit of turbulence within the investing cycle where you can go back and look at sponsors' track record. And the thing I would recommend first and foremost is looking at deals they've done, projected NOIs or net operating incomes of projects at takeover, and then where they were supposed to be, 2, 3, 4 years down the road, and seeing what they actually achieved. Because ultimately, outside of any organic appreciation, the way that we drive value on these projects is increasing that net operating income. And so if a sponsor can take over a project, project what they're going to be able to hit as far as that net operating income, and then go execute on it and be successful, that in my mind is the strongest indication of what's going to show success in the future. And of course, there's a lot of other things that you can ask in terms of your typical integrity type of questions, trying to make sure that your values align with the values of the sponsor. Do your investing interests align with theirs in terms of market, risk profile, things like that. But the ability to basically do what they said they would do on a business plan is going to be the key to making sure that you're putting your investment in a secure place.
Mhm. So, with all of this, you got a number of investors that are climbing on board and they're going to be interested. Is there anything that we need to be aware of regarding prioritizing those investors or establishing with them some sort of agreement so that they know what they're getting into?
Yeah. So I think there's ways I could run with this question. One is the sort of legal component to it. So, we have to register our offerings with the SEC, the Securities Exchange Commission. If you're familiar with multifamily, might know there's two different exemptions you can file for. One is 506B, where we can take non-accredited investors, but we only take investors we have a relationship with. The other is 506C, where we can only take accredited investors, but we can take any accredited investor. And so, first of all, you have to follow all the rules set forth by the SEC. I think that beyond that, one thing that investors should look for is, very clear definition of the business plan and the partnership. And that really is driven by three different things. One is the investment summary, which is your typical pitch deck that you probably see first, where the project, the business plan, and the projections should be laid out in a very clear, logical order that makes sense to you as an investor, that you think this is achievable. The second thing to look at would be the operating agreement. And this is the legal document where all the splits and profit sharing and stuff like control of the deal is going to be explicitly and legally laid out. And that should match what you see written in that investment summary as well, right? And then the final thing is your PPM or private placement memorandum. And that's a document that specifically addresses the risk. Investors should review that document to be aware of what risks are inherent to this particular project and make sure that it meshes with their particular appetite for risk.
Has there been any lessons in working with them, communicating with them, any red, maybe even some red flags in which you've decided that that passive investor may not be a good fit?
Yeah. First of all, I'd probably say that I've been not only an active investor, I've also passively invested in other sponsors' deals in the past. And I've learned a little bit from both sides of this street, so to speak. I think the most important thing on the active investor side is communication. Obviously, we lay out the best plan. We're pretty fortunate that our deals are doing very well in this economy compared to many that we've seen. But, things sometimes go extremely well and sometimes there's challenges. Regardless of which way it's going on a particular month, you need to be able to communicate that with investors where they understand where their project and their investment is and good or bad, what you're doing going forward. Obviously we have a very clear business plan that's laid out, but there's still some flexibility and pivoting that we have to do along the way as we see different things happen. For example, taxes and insurance go through the roof in the years 21 and 22. How do we respond to that? What do we do differently? And you need to be able to communicate that to your investors. I think on the other side of things, as a passive investor, I really want to look for sponsors where I feel like my values and interests align. Oftentimes, one mistake that I've made as a passive investor is thinking that someone who seems nice or friendly, that lines up with someone who's competent in the industry. And those can be two different things. You can be a very well-intentioning, kind person, but not necessarily be competent as an investor. You want to look for both of those when you're investing passively in the sponsor that you choose.
Mhm. Just to remind everybody, we're talking to Jonathan Nichols at Apogee MFC. So, and you can find more information there if you're interested in this. So, Jonathan, I'd be curious, after doing this for a number of years now, what has been your most expensive mistake?
Wow. I would say maybe a couple of things. One is, and probably one of the great things for me is that because Paula and I invested in the single family before the multifamily, when you start something new, there's always a dumb tax, right? And fortunately for our investors, we got to pay most of that dumb tax before we entered into the multifamily role. And so there was a lot of lessons learned there. But, I've had things before, particularly with renovations, where you try to get the cheaper guy, right? Put in the floor to paint the wall, and they do a poor quality job, and you have to go back and do it again, which obviously winds up being more expensive than if you had the really good guy up front. So one thing, on our renovations is I really try to focus on the quality first and the cost second. We're very, very cost conscious, but if you don't put the quality first, you wind up paying more in the long run. It wasn't done well. Trust but verify is also an important thing across the board. Someone says, whether it's a property manager, oh yeah, I put this notice out to the resident. This project, and always ask for pictures, ask for proof, keep an eye on reports and stuff that indicate things. That's probably the biggest thing. CapEx is one where a lot of people go sideways pretty quickly just because it's a people business in addition to a numbers game. And if you're not good at assessing people, working with people, and motivating people when necessary, that's where you can have a lot of dollars get burned pretty quick.
Sure. So, what has been in your opinion, your biggest win?
For me, one of my value propositions to my investors is, if I've already said on the podcast, I worked as an aerospace engineer and we do a lot of numbers, a lot of analysis. We also do a lot of risk assessment. What is the probability that such and such part breaks so that this problem happens? And So we do a lot of risk assessment. And so I spend a lot of time in the investing world thinking about risk, trying to figure out how to minimize it. And I think one thing that we did really well is myself as a new investor in the multifamily world during 2020, 21, there were a lot of deals for listeners that may be unaware where people were using really high leverage bridge loans. And basically in their analysis, assuming that their buyer one day would have access to that same level of debt in the future, which affects what their future buyer could pay for that deal. Well, lo and behold, of course, as your listeners know, interest rates went up. The debt market is much softer than what it was, as is the real estate market. And so the valuations of properties have gone down. And folks who are in those really high leverage floating rate debt loan products are really struggling. In some cases, deals have been foreclosed on. And I remember having conversations with one mortgage broker in particular and expressing the concerns that I had about that during 21. And he agreed with me. He's like, yeah, I think that makes a lot of sense. And it's probably better if you can avoid that, on your projects if possible. And so we went the route of only doing projects with long-term fixed rate debt. And so all our multifamily projects from 2020 through 23 are like 3 and 4% loans on 5, 7, 10-year terms. And so that's really helped us a lot going through the turbulent times that we've seen the last couple of years, because we're still able to do distributions to invest. We're still able to, hold on to properties and continue running them like normal. And it will ultimately allow us to exit in the future at a time that is most favorable to investors. It might seem a little underwhelming, but I think just making that choice of risk was a huge win for our business and our investors.
Perfect. Well, Jonathan, this has been a fantastic conversation. Before we jump into the rapid fire questions and close out this episode, is there anything we should have covered that I might have missed?
No, I don't think it's been pretty thorough. I would just mention, we're going into 2025. We are in 2025. Maybe you have listeners that are newer to real estate. Highly recommend jump into it. Whether you're doing single family, multifamily, active, passive investing, learn some avenue or route of investing and just get going. You'll thank yourself several years later. I certainly thank myself and my wife. We jumped in several years back. And so that would be my advice going into the new year.
Well, Jonathan, that's fantastic. If you're ready, we'll jump into the rapid fire questions and close out this episode. So the first one is, what lie do real estate investors tell themselves?
It's kind of a repeat of what we said earlier, but that investing is passive, right? If you want to be an active investor, it is work and it's not always on your timeline or schedule.
If you could go back in time and give your younger self a piece of advice, what would it be?
When I graduated college, I would have purchased a house instead of renting an apartment for 4 years.
Do you have a book recommendation or what now?
Right now, I just read the book. I know it's really popular, Buy Back Your Time. Really interested in that a lot. Even though I've already said real estate's active, I do believe that the ability to leverage other people's time and experience and strengths is really important if you want to be successful as an entrepreneur. So I would really recommend Buy Back Your Time by Dan.
And the last one is, what single strategy or tool have you implemented that has had the biggest time-saving impact to you or your business?
For saving time, probably Asana. We use Asana project management software for our multifamily, our single family. Allow everyone to work together in one spot, know what's going on, keep there from being balls dropped. So that's been a huge win on the time.
Well, Jonathan, this has been fantastic. One last time, it is apogeemfc.com, apogeemfc.com. That's going to be a clickable link in the show notes, but really appreciate your time. It's been great chatting with you.
Thanks, Jack. I appreciate the opportunity.